Hey there, future investors. Ever wondered what makes a stock tick? Why some skyrocket while others plummet? The secret lies in understanding stock valuation. Simply put, it's like figuring out the worth of a used car before buying. You don't want to overpay, right? Stock valuation is all about determining the intrinsic value of a company's stock. Is it a bargain, a ripoff, or just right? This knowledge empowers you to make smart investment decisions. Remember, buying a stock is buying a piece of a business. Its success determines your returns. So, are you ready to unlock the secrets of stock valuation? Get ready to impress yourself and your broker with your newfound knowledge. Let's dive into this exciting world and empower you to make informed investment decisions. Think of stock valuation like detective work. We're on a quest to uncover the true worth of a company, and there are two main approaches we can take: fundamental analysis and relative valuation. Fundamental analysis is like examining the company's DNA. We scrutinize its financial statements, industry trends, and management quality. Think of it as looking under the hood of a car before buying it. Relative valuation, on the other hand, compares the stock to its peers. It's like comparing the used car you're eyeing to similar models in the market. We use metrics like price-to-earnings ratio, or PE, and price-to-book ratio, or PB, to see if the stock is overvalued or undervalued. All right, let's cut to the chase. What exactly is stock valuation? In simplest terms, it's like figuring out what a stock is actually worth. Think of it like this. You're at a flea market and you see a vintage watch. The seller is asking for $100. Is it a steal, or are you about to get ripped off? Stock valuation helps us answer that question. It's about determining if the asking price, the stock price, aligns with what the stock is truly worth. This true worth is what we call intrinsic value. It's like figuring out if that vintage watch is actually a rare collectible or just a dusty old timepiece. Now, you might be wondering, why bother? Can't I just buy stocks that are going up? Sure, you could try that, but without understanding valuation, you're essentially flying blind. You're just gambling, not investing. Here's the deal. Stock valuation is your secret weapon in the market. It empowers you to make informed decisions, not impulsive ones. It's the difference between throwing darts at a board and strategically aiming for the bullseye. Think about it. If you can identify undervalued stocks trading below their intrinsic value, you're essentially buying assets on sale. You're getting more bang for your buck. On the flip side, valuation helps you avoid overpaying for hyped-up stocks that might be overpriced. Remember, investing is a marathon, not a sprint. Stock valuation provides you with a long-term perspective, helping you build a portfolio that aligns with your financial goals. It's about making smart choices that generate sustainable returns over time. Section 3. Price versus value. Don't be fooled. Price is what you pay, value is what you get. Many investors get tripped up here. Price fluctuates with market sentiment. Value is based on fundamentals. Like gold's weight, true value remains constant. Price driven by hype, value by performance. Imagine a bakery selling cakes. A blogger raves. Demand surges. Price doubles, but value stays the same. Intrinsic value of the cake, unchanged. Segment 2. 2. Main approaches to valuing stocks. Section 1. Fundamental analysis. Looking under the hood. Let's dive into the world of fundamental analysis, where we act like financial detectives. Imagine putting on your Sherlock Holmes hat and grabbing your magnifying glass as we investigate a company's financials, industry trends, and management. We're looking for clues about a company's true earning power and growth potential. Think of it like kicking the tires and checking under the hood of a used car before buying it. You don't want any surprises, right? Fundamental analysis helps us avoid those investment lemons. We use this approach to determine a company's intrinsic value, what it's truly worth based on its own merits, not just the market hype. This helps us identify stocks that are potentially undervalued or overvalued. Remember, knowledge is power in the stock market. Section 2, EPS, the profitability powerhouse. One of the most crucial metrics in fundamental analysis is earnings per share, or EPS. It's like a company's report card, showing how much profit it generates for each share of stock outstanding. Think of it as slices of a profit pie, and each share represents a slice. To calculate EPS, we take a company's net income, its total profit, and divide it by the number of outstanding shares. The higher the EPS, the more profitable the company is on a per-share basis. Simple, right? EPS is a powerful indicator of a company's financial health and its ability to generate profits for its shareholders. It's a key factor to consider when evaluating investment opportunities. Remember, we want companies with a history of strong and growing EPS. Now let's talk about two popular valuation ratios that investors use to gauge a stock's relative worth: the price-to-earnings, or PE ratio, and the price-to-book, or PB ratio. These ratios help us understand if a stock is cheap or expensive compared to its earnings and assets. The PE ratio tells us how much investors are willing to pay for each dollar of a company's earnings. A high PE ratio might indicate that investors are optimistic about the company's future growth prospects, while a low PE ratio could suggest undervaluation. The PB ratio compares a company's stock price to its book value per share, which is the value of its assets minus its liabilities. A low PB ratio could indicate that the stock is undervalued relative to the company's net worth. It's like finding a hidden treasure chest. Relative valuation is like comparing apples to apples in the stock market. Instead of looking at a company in isolation, we compare its valuation metrics to those of its industry peers, or the overall market. We use ratios like PE, PB, and others to see if a stock is trading at a discount or premium compared to its competitors. For example, if a company has a lower PE ratio than its industry average, it might be undervalued. It's like finding a bargain at a flea market. However, remember that no single valuation metric tells the whole story. It's crucial to consider multiple factors and conduct thorough research before making any investment decisions. Don't just rely on one number. Look at the bigger picture. Now, let's step into the realm of intrinsic valuation, where we put on our future predicting hats. One powerful method we use is discounted cash flow, or DCF analysis. It's like having a crystal ball that helps us estimate the present value of a company's future cash flows. Imagine a company as a money-making machine. DCF analysis helps us calculate how much those future earnings are worth in today's dollars, considering the time value of money. It's like figuring out how much you need to invest today to receive a specific amount in the future. DCF analysis can be complex, but it's a valuable tool for experienced investors to estimate a company's intrinsic value. By discounting future cash flows back to the present, we can get a better sense of whether a stock is a good investment opportunity. All right, folks, let's get down to business. Before you even think about crunching numbers, you gotta understand the company behind the stock. Remember, investing in a stock is like buying a small piece of that business, so do your homework. Start by exploring the company's website, reading industry reports, and checking out their competition. What do they sell? Who are their customers? What's their competitive edge? This is about understanding their story, their challenges, and their opportunities. Imagine you're buying a restaurant. You wouldn't just look at the menu, right? You'd want to know the chef's reputation, the location, the ambiance. The same goes for stocks. Dig deep. Get a feel for the company's culture and management team. Are they innovative? Ethical? These factors matter. Now let's talk numbers. Financial statements are like a company's report card, giving you a snapshot of their financial health. Don't worry, you don't need to be an accountant to understand the basics. Think of it like checking your bank account. You want to see where the money's coming from and where it's going. The three main financial statements are the balance sheet, the income statement, and the cash flow statement. Each tells a different part of the story, like chapters in a book. Together, they paint a comprehensive picture of a company's financial position and performance. Public companies are required to release these statements regularly, and you can usually find them on their websites in the Investor Relations section. Don't be intimidated by the jargon. We'll break it down into bite-sized pieces. Remember, knowledge is power, and understanding these statements gives you an edge in the market. First up, the balance sheet. This statement gives you a snapshot of a company's assets, what it owns, its liabilities, what it owes, and its equity, what's left over for shareholders. Think of it like a scale: assets on one side, liabilities and equity on the other. Assets include things like cash, inventory, and equipment. Liabilities include things like debt and accounts payable. Equity represents the shareholder's stake in the company. A strong balance sheet usually means a healthy company. Look for companies with more assets than liabilities. That's a good sign. Also, pay attention to how much debt a company has. Too much debt can be risky, while a manageable amount can be used strategically for growth. Remember, the balance sheet provides a foundation for understanding a company's financial strength and stability. Section 4. Income Statement Insights. Following the money trail. Next, we have the income statement, also known as the profit and loss statement. This statement shows how much revenue a company generated over a period of time, the costs it incurred, and the resulting profit or loss. Think of it like tracking your income and expenses for a month. The income statement starts with revenue, then subtracts the cost of goods sold to get the gross profit. Then, it subtracts operating expenses like salaries and rent to arrive at operating income. Finally, it factors in taxes and other income to calculate the net income, the bottom line. Pay close attention to trends in revenue and net income. Are they growing? Declining? What are the profit margins like? The income statement reveals a company's earning power and its ability to generate profits from its operations. Section 5. Cash flow is king, the lifeblood of a business. Last but not least, we have the cash flow statement, arguably the most important of the three. This statement tracks the movement of cash both in and out of a company during a specific period. It shows how a company is generating and using its cash. The cash flow statement is divided into three sections: operating activities, investing activities, and financing activities. Operating activities focus on the core business operations like sales and expenses. Investing activities include purchases and sales of long-term assets like equipment. Financing activities involve debt, equity, and dividends. Remember, cash flow is the lifeblood of a business. A company can't survive without it. Look for companies with strong and consistent cash flow from operations. This indicates a healthy business that can generate cash to fund its operations, invest in growth, and reward shareholders. Section 6. Growth Potential, Riding the Wave of Success. Alright, now that we've got a handle on the financials, let's talk about growth. Investing in a company is like planting a seed. You want to see it grow and flourish over time. But how do we assess a company's growth potential? Look for companies with a history of increasing revenue, earnings, and market share. Are they expanding into new markets? Developing innovative products? These are all positive signs of growth. Remember, past performance is not a guarantee of future results, but it can provide valuable insights. Also, consider the industry and the overall economy. Are there any tailwinds that could boost growth? Any headwinds that could hinder it? Understanding the broader context is crucial when evaluating a company's growth prospects. Remember, invest in companies that are well-positioned for future success. Section 7. Industry benchmarks, sizing up the competition. Now let's put things into perspective. Relative valuation is all about comparing a company's metrics to its industry peers or the overall market. It's like comparing apples to apples, or in this case, stocks to stocks. We use valuation ratios like PE, PB, and others to see if a stock is trading at a discount or premium to its competitors. For example, if a company has a lower PE ratio than its industry average, it might be undervalued and potentially a good investment opportunity. However, keep in mind that industry averages can vary widely, and what's considered cheap in one industry might be considered expensive in another. It's crucial to consider the specific industry dynamics, competitive landscape, and growth prospects when making comparisons. Section 8. Macro factors, the economic winds of change. Finally, let's not forget about the bigger picture, the macro environment. Just like a ship sailing on the ocean, companies are influenced by economic winds and tides. Factors like interest rates, inflation, and economic growth can impact a company's performance and valuation. For example, rising interest rates can increase borrowing costs for companies, potentially impacting their profitability and growth. High inflation can erode consumer purchasing power, potentially impacting demand for a company's products or services. Economic recessions can lead to decreased consumer spending and business investment, potentially impacting corporate profits and stock valuations. It's crucial to stay informed about macroeconomic trends and assess their potential impact on the companies and industries you're interested in investing in. Remember, investing is not just about picking stocks. It's about understanding the broader economic context and making informed decisions based on your analysis and risk tolerance. All right, future Wall Street wizards. Now that you're familiar with the fundamentals of stock valuation, let's talk tools. Just like a carpenter needs a trusty hammer and saw, you need the right tools to navigate the exciting world of investing. Don't worry, we're not talking about complicated algorithms or expensive software here. We're keeping it simple and accessible. First up, stock screeners. These handy online tools let you filter stocks based on specific criteria, like industry, market cap, or valuation ratios. Think of it like having a personal assistant who sorts through thousands of stocks to find the ones that match your investment style and goals. Some popular options include Yahoo Finance, Google Finance, and FinViz. Next, let's talk brokerage accounts. Most online brokers offer research tools and educational resources to their clients. These platforms often provide analyst ratings, company profiles, and even stock valuation models. It's like having a financial advisor right at your fingertips. Some popular choices include Fidelity, Schwab, and TD Ameritrade. Now, let's explore the vast world of online resources. The internet is a treasure trove of financial information, from educational websites to investment forums. Remember, knowledge is power, and the more you learn, the more confident you'll become as an investor. One of my personal favorites is Investopedia. It's like the Wikipedia of finance, offering clear and concise explanations of complex financial concepts, including valuation techniques. They even have a dictionary of financial terms, so you can impress your friends with your newfound vocabulary. Another great resource is Seeking Alpha. It's a platform where investors and analysts share their insights and analysis on individual stocks and the market as a whole. It's like attending a virtual investment conference where you can learn from both seasoned professionals and fellow investors. Remember, investing is a marathon, not a sprint. It's about making informed decisions, managing your risk, and staying disciplined over the long term. The tools and resources we've discussed today are here to empower you on your investment journey. Don't be afraid to experiment with different valuation methods and tools. Find what works best for you and your investment style. And most importantly, never stop learning. The financial world is constantly evolving, so staying curious and informed is essential. Remember, investing should be both challenging and rewarding. So embrace the learning process, stay disciplined, and watch your portfolio grow over time. And who knows, Maybe one day you'll be sharing your own investment wisdom with the world. There you have it, folks. We've journeyed through the ins and outs of stock valuation, from understanding the basics to utilizing powerful tools. Remember, knowledge is power, and you're now armed with the knowledge to make smarter investment decisions. Don't let the stock market intimidate you. With a little effort and the right tools, you can unlock its secrets and potentially grow your wealth over time. Remember, investing is a marathon, not a sprint. Be patient, stay disciplined, and never stop learning. Now, go out there and put your newfound knowledge into action. Research companies, analyze their financials, and make informed investment decisions. And remember, the most important investment you can make is in yourself. Keep learning, keep growing, and watch your financial future brighten with each smart decision you make.